Good afternoon, everybody. This is Stan for theartofchart.net, and this is a recording for trader education called Using Fibonacci Sequences in Trading. This is a re-recording because, for whatever reason, in the middle of our original recording, we actually got hung and the network didn't cooperate, and we lost half the recording. So I'm going to re-record the first half and just put it together with the back half, and hopefully this will work. So our disclaimer again, for everything we do on theartofchart.net, we do what we do for educational purposes only. We don't issue trading signals. This workshop is about Fibonacci sequences and how to use them in trading. And what we usually do on theartofchart.net is we go over a brief outline. And so for this workshop, we're going to be talking about just an overview of what are Fibonacci sequences. Number two, how do you draw them, and what are the three types? The three types are extensions, expansions, and retracements, and all three are important. And we'll get into all three in this workshop. And we'll talk about impulses and predicting the support and resistance that you might see in an impulse, but also we'll talk about support and resistance in retracements as well. And we'll get to questions at the end. And I'd like to begin by first introducing Antonio Fibonacci. Okay, this is the gentleman that came up with Fibonacci sequences. And let's just scroll down and we'll talk about what a Fibonacci sequence actually is. It's actually a very simple mathematical tool, and Antonio invented basically this sequence, which is 1 plus 1 is what? 2. 1 plus 2 is what? 3. 2 plus 3 is what? 5. 3 plus 5 is what? 8. That's a Fibonacci sequence. And you do 1 divided by 1 and you get a number called pi, okay? Or phi, I should say. And 2 divided by 1 is what? 2. And 3 divided by 2 is what? 1.5, etc. So these are the Fibonacci ratios that you might use, and they don't work out exactly the way a lot of people think they work out. You know, everybody's familiar with 0.618 and 0.382 and 1.618, but there also are sequences like 2.0. and 1.5 and 1.66. And some of them are seldom used, but they exist. So, and the reason Fibonacci sequences work, and this is key, is that we have a lot of code out there and we have a lot of people out there that use them. Okay, and a lot of people get into Fibonacci sequences and how everything in nature is composed of Fibonacci sequences. Okay, well, that's a valid way of looking at it. However, you know, the amount of time that I see the market go to a 100% fib draw, it is remarkable how often that happens and how much support and resistance is actually discovered there. And so for me, a lot of that is not necessarily everything in nature is composed of Fibonacci sequences. It's about, there are a lot of people out there using these sequences, and it is good practice for you as a trader to understand how to use them. And what I'm going to do tonight is just take the E-mini. We're going to do a couple of very, very brief examples of Fibonacci draws, and you guys requested this workshop, so we're gonna do this. And I'm re-recording the first part of it just to recover the file that got corrupted, and I'll put this together with the back half of the workshop, which we do have, and hopefully you guys can use this and refer to it. So bottom line is this. The fundamental nature of the market, in many respects, it typically organizes itself in threes, okay, in three-wave moves. And I'm going to show you like this sequence here, which, by the way, we absolutely, we were deadly on this sequence on the way down. And all of our subscribers, all the way down to 1807, we hit every single turn. And one of the reasons why we did, of course, using trend lines, which helps, but also using Fibonacci sequences. So from the black X here, for example, let's just do a quick fib draw. So I'm taking my fib extension tool, okay? And so from the initiation point there, X, I go to the swing low, which is 1871. There's your A, if you will. Here's your B up here at the X wave, if you will, okay? Where's your 100% fib? Right here, 1854. Now, is it precise to the number? No, it's pretty close to the number. It's an area, okay? So swing trading and the use of Fibonacci sequences on a 1-hour chart, you better be looking for areas, okay? Now, if you're using a 5-minute chart and you're a day trader, you can use Fib sequences there too. It's going to be a lot more accurate just because of the nature of the chart that you're using. So, here we have 100% Fib, okay? So what would you expect to see there? Support, okay? Now, let's just do another Fib draw, which let's just do a retracement, for example. Let's just do this one. So we have 100% down. Let's see what happens on the way back. Okay, we get an impulse higher, right? And so from here, we get the impulse higher. We get a back test. And look where we land, between the 100% Fib and the 1.236. So if you look here, you can see the 100% Fib and the 1.236. For me, that's the area that I typically look for. Okay, so there's another 100% Fib. Now, let me delete these and kind of clean these up a little bit. Let me show you another one. Okay, so we have a WXY and we have an X, which is nothing but a connector wave. Okay, and I'll show you this Fib draw. I'm going to go all the way to the Y. Okay, then I'm going to go up to the X. And what do we have? 100% Fib, 1910. Okay, the low is actually 1907. And by the way, I'm trying to show you the simple, easy approach to get you started with Fibs. Okay, there's much more complexity than what I'm showing you. Okay, but this is a good introduction for you to start doing basic Fib draws and looking for the 100 to 1.236 area for a turn. Very often it's near the 100% area. Now, those are not the only Fibs that you use. For example, in this finishing move here, we had the 0.618 Fib, okay? So typically in a 3-wave move, in an impulse like this one, okay? We have a 3-wave move down for the 100% Fib, we have a small back test, and then we have a finishing move. So this is a 5-wave sequence, okay? So if I drew the Fib in a 5-wave sequence, if I think there's a 5-wave sequence, here's your extension Fib again, okay? Here's your extension Fib, and I do this, and I get my 618 right at 1807 is where it falls. I didn't draw it precisely, but you get the idea. So the 100% Fib, the 1.618, and there's another one to really look at and look at the market with, which is this one, the traditional Elliott sequence. Let's just talk about that. The traditional Elliott sequence looks like this. Okay, here's your draw, your swing low, okay? And we go up to the back test of wave X. Where does your 1.618 come in? Right here, okay? So very often in a 5-wave sequence, you get your first impulse, you get your back test, and usually on the E-mini, if you use retracements, which Jack is going to do an example of a retracement very shortly here. This is the 786. This back test, okay? The 786 is a favorite Fib for the E-mini and for the S&P. So typically, your 0.618 to 0.382, that's known as the golden ratio zone, okay? So typically price comes up into this area, but for the S&P, and every instrument's a little different, it likes the 0.786, and I just want you to remember that. So, here we came all the way back to the 0.786, okay? We came down, there's your 100%, okay, and then we came lower down to the 1.618. So you could count this as a WX. Here would be your Y. Now, I did not count it this way, okay? This would be the traditional way of counting it in an Elliott sequence, okay? You would get 3 waves back, and then you would expect lower prices. And you would expect lower prices down to the 2.618 down to 1731. The point I'm trying to make here is that, the traditional way of looking at Elliott in 5, it doesn't work as frequently as it should, and it doesn't measure as frequently as it should. It's changed over the years, okay? So I'm into looking at Elliott from a 3-wave perspective and looking at Fib extensions as a way of doing measurements, as well as retracements and expansions, which we're about to get into with you. So at this point, I'm going to stop this recording, and since I've introduced the whole concept of Fib extensions and using Fibonacci's, I'm going to stop here and concatenate this video with the other video. Yeah, I'm back up too, Jack. Sorry about that. Just a weird system problem, which I've never had before. The system just completely hung. I'm going to have to look for viruses, but I'm going to finish this sequence. I'm going to throw it back to you, Jack, and you can do the retracement example. But a fib extension basically. Here's a W. There would be your 1. Here would be your 2. Here's a 3-wave move for your third wave, 1.618, very typical. So again, you have multiple ways of drawing your fib to get right to this level. I mean, geez, like I've shown you 4 or 5 different ways to get to 1807. Typically then you would get a back test, and then you would get your 5th wave all the way down here to 1733. Okay. Now, again, this didn't work in a 5-wave sequence, and the traditional Elliott 5-wave move doesn't really work as often as it used to. It doesn't mean you don't look for it. I still look for it. Anyway, so that's the basics of doing extension draws, okay? And so looking for 0.618, looking for 100% or between 100% and 1.236, looking for 1.618 as well in 3-wave sequences. That's at a very high level basically what I look for most of the time. And there are other fib sequences for extensions, but that gets kind of complicated. So I'm just sticking to the basics for now and kind of showing you that as a starting point. Jack, let me throw it back to you if you want to do a retracement example.
All right. Right, hang on, just dragging the charts across. Right, one thing I wrote a post a couple of years ago, and that was on hang on a second, just pull this over. That was on secular patterns and long-term market moves. Now, this is something I've talked about a number of times in terms of watching patterns and the importance of Fibonacci's with patterns, with trending patterns. And this is a very good example. This is 80 to 87. This is an example of a crash which people were thinking was disorganized, and it came from nowhere and no one knew where it was going and it was chaotic, and actually it really wasn't. You were looking at a retracement of a bull market which obviously started here in 82. You had 2 patterns which were a rising wedge which broke up into a rising megaphone, which then overthrew slightly at the top, came down. The only thing that was really difficult to call on this was the speed, because you'd have naturally thought bounce around here, maybe put it in the left shoulder, and actually it just went straight through support, gapped through it, and went down to, what was it? The 50% fib. Pretty much exactly. It was just beautiful. So actually, really what you were looking at was just a standard retracement. It just happened really fast. And that is something you see quite readily. I've got another beauty here, actually. And hang on, wait a second, where is it? Right, now this one is nice. I just want to point this out, because actually I just looked at this chart just now when I was putting up examples. I looked at this chart for the first time in a couple of years. I used this on a post I did in 2013 when I was demonstrating that this was a perfect retracement of this whole bull market from here. Yeah, came up to here, and this was effectively you're taking wave 3, wave 4, wave 5, and then you're drawing a retracement of the whole thing. Where does that end up? It ends up almost precisely at the 61.8% fib retracement for that 666 low. So again, not actually terribly chaotic. And you do find that, I mean, the reality is anything, you can talk about algos and HFT and all this sort of stuff, but the reality is actually fibs were important a long time before computers were.
Yeah, absolutely.
Fibs are important on anything which involves math. And trend lines are also an expression of a mathematical constraint. And actually, you look at this, I hadn't looked at it in 2 years. I'd drawn these, actually, I think, I might have redrawn this more recently, because I wonder if it would come out that far. But I hadn't looked at it in a while. Look where the top was. Perfect. Beautiful. Does this mean I think we're going down to this lower trend line? No, it doesn't. But I think we are about to do, this actually turned out to be a rising megaphone from here, I think, and I think we're going to break support, which we've currently got in about 1750 area, and we should do a Fibonacci retracement of this move, and then it goes up. But it's beautiful the way it's reversed that trend line. I'm really not expecting it to make it to this one. But it's lovely. This is a lovely example of a Fibonacci retracement. It's also another way where it's a way of showing that you can actually use Fibonacci's to work out what the wave structure is. Because here, once you see that Fibonacci retracement there and how perfect it is, it's very obvious that this bull market didn't actually end here; it ended here. And actually, that's very common on secular series, because you have a series of cyclical bull and bear markets. Not that many bear markets in this particular series, but obviously we have 87, which looks tiny down there. But we then get retracement, last move up retracement. This is actually a very, very standard setup and a beautiful Fibonacci retracement, and then off it goes. It's very, very nice indeed. So, I mean, there's a lot of discussion about whether this was the end of the bull market in 1980, but actually it wasn't. It was this. Mathematically, it needed to be this, and actually, it makes perfect sense with that setup. All right. Shall I do some more short-term examples?
Sure.
Right.
I want to show the opposite of a fib retracement after you finish with retracements.
Okay. These patterns are widely misunderstood, and the reason that they're widely misunderstood is you get a broadening wedge or megaphone like this one, or a falling wedge or a channel, and then certainly on the wedge and the megaphone, the official target is basically the 100% retracement. Which in this case would be the 100% fib retracement. But actually it doesn't get there, and so Bulkowski regards these as weak patterns, but actually these are Fibonacci patterns. You only get 100% retracement if you're at the end of the cycle. Otherwise, you're very likely to get, you'll sometimes get a 23.6, but normally you're looking for the 38, the 50, or the 61.8. Where is the high? On the current rally, it's here. It's almost exactly at the 38.2% retracement. It may well go higher. That it's reversed there isn't particularly surprising. That you will often see that. This may actually be, and this is something I'm bearing in mind at the moment, we are expecting another move up, but we may not guess it. It could potentially fail here. And this is, of course, a rising wedge, and I think this is a 38% Fibonacci retracement. And we formed a potential double top, and we're waiting to see whether that double top will break down. If so, this would actually target a 76.4, I think. Anyway, we shall see how that develops, but again, very obvious target. As soon as I get a pattern that breaks, I draw in, and I've got my levels. And normally you'll find in a retracement that you will go to this one, or this one, unless it's a very, very strong trend, in which case you might fail at 23 and continue. All right, great. That's my examples done.
Okay.
Pass back to you, Stan.
Yeah, sure.
Okay.
So we've just shown you Fibonacci, what I call retracements. That's what Jack just showed you, the 0.382 and the 0.5 and the 0.618. And I showed you earlier the fib extensions, okay, where you're looking for ABCs, okay, and the different ways and the different Fibonacci numbers that you look for there. I'm going to talk about something that a lot of people don't talk about, and that's Fibonacci expansions. Now, here's your Fibonacci extension tool right here. Okay, so this is what Jack just showed you. Okay, which is your 0.618, 0.5, and 0.382. Okay, now here's what happens when you look at a Fibonacci expansion. It's basically this, but instead of, for example, 0.618, what would the 100 be? The 100 would be here at the B. What would the 1.236 be? It would be roughly right about here. Okay. Well, what about the 1.618? It's way up here. So do you see what I'm doing? This is 100%, right? From B to 4. And 0.5 is here. Well, 1.618 is here. That's called a Fibonacci expansion, okay? So, some trading systems do not have Fibonacci expansions. If you don't, you use your Fibonacci retracement tool and you put in 1.236 and 1.618. Now, the way this is used and the way that I use it, and this is very valuable, Everybody knows when you get a very strong impulse, like we just had a very strong impulse in the S&Ps, right? Very strong impulse, you get a retracement, usually a small one like Jack just showed you, the 0.236. Here's a Fibonacci expansion to predict where the low will be. So right here is the expansion from the 3 to the 4. Okay, and look where it put look where it put the expansion. 693. Now everybody knows 666 was where the bottom was, right? So all I'm trying to say is this is how I draw an early target. The 1.236 is a Fibonacci expansion that helps me predict the length of a fifth wave. It doesn't always work, but it gives me the early target, okay? There are other ways to come up with targets that are a little bit more complex. I won't get into all that now, but that's what an expansion is. And by the way, let's look at this expansion, okay? When you have a major impulse, and this is a monthly chart, guys, okay? And Fibonacci's work monthly, weekly, daily, 1 minute, 5 minute, they work, okay? I'm going to use an expansion from the B to the 4. And I have to change my fibs here. You can see where the 1.236 is, right? But if I add, and I have a bunch of different expansions here, but if I add my 1.618, look where it lands. It lands up here. And what number is that? 2138. Now, you guys know where we topped? Where did we top? 21, was it 32 or 34s, Jack? I'm trying to remember. I don't remember. I think it was 34. Yeah, right. So, you know, if you know anything about expansions and you're long at 666, and by the way, that day I was long, okay? And I won't tell you what I did. I didn't hold it long enough, obviously. But, you know, if you're a smart guy and you have a good sense of the market and you look for expansions of 1.236 and 1.618, depending upon the length of the impulse, you got two potential zones to look for, okay? And look at this. If you were, and by the way, that line has been on my chart since we were at 1820. Since we were at 1820 right here back in 2014, this line has been on my chart. And we, Jack, you remember, we talked about this for like 6 months, okay? So, yeah, so you know, Fibonacci's are very valuable, and you can see the 0.382, 0.5, and 0.618 on my chart here. We haven't hit the 0.382 yet, which is down here at 1790, and we're looking for that. So, you know, this works at multiple time frames, and so you got three tools. You got expansions, which we just showed you. You got retracements, which Jack showed you, and earlier I showed you extensions. So those are the basic tools that you use with Fibonacci's and the basic levels. Now there's more advanced stuff, but I think what we're trying to do is introduce basics here because some people have been asking, can you show us about fibs? Can you show us about fibs? So that's why we're doing
a webinar. Expansion example.
Yeah, please.
I've got an expansion example if you want.
Yeah, sure. Let me throw it back to you. And guys, go ahead and put your questions in, and we'll deal with questions after Jack's example.
Right, now, in the same post in 2013, I was talking about a target. This was I was treating this as a secular pattern. I drew it in basically as a triangle, a descending triangle, and I put in a target for going above, and I think I called that at 2440. That's actually a match with the Fibonacci extension target. I've got here 2490. 2493 is the 161.8. And actually, you see that a lot. We may well run through to that. That's going to be a target that I'll be watching as and when we get there. This was on the triangle draw of this, I think, because I think what we're going to do here, if we came back and we tested here, that would be a 50% retracement. That would be a 38.2% retracement of the move up from the 2009 low, and that would be a natural springboard to go off and get this target, which is what I'm expecting to do on the basis of this secular pattern. I'm drawing the trend line along here and here. This trend line obviously was important as well, but I don't think this is the end of the move. We should just come back and retest. And actually, this pattern here that you can either read this as a head and shoulder pattern or as a double top. But if you read it as a double top, the target is pretty much exactly at that line. Mm-hmm. And on the 38.2% fib. So if we continue down here, and we might have a bounce at the at the rising support from 666, then if we continue down and we break through that, then that will be the natural target. And on the bigger picture, that would be a retest of this break and resistance before we go off and make the main target, which is essentially around in this area here. All right, anyway, that was just a quick expansion example.
That's a great example. That's a great example. I guess, Jack, is there anything else? Let's just go back to the outline, because I think we basically have covered it, right? The outline we started with, which, by the way, I don't have. Let me see if I can recover my file, because I crashed. Share recovered files.
I could share more examples. They're everywhere, pretty much.
Let me just pull this up. So we showed you, we did the overview, we did the how to draw, we talked about impulses and retracements. We've talked about extensions and retracements and expansions. We do have one question, Jack, if you want to answer this one now.
Yeah.
How do you determine when to use Fibonacci extensions, expansions, and retracements?
Well, it rather depends on the direction of the break. I mean, for instance, if a wedge breaks up, I tend to obviously track the patterns. Almost all trends will fall into a variant of a channel. There will either be a channel with parallel lines, or there will be a megaphone with expanding lines, or there will be a wedge with contracting lines. There will be one of those three, particularly on the wedges and the megaphones. You're liable to get overthrows, the classic, and I showed you one of those on the 87 one, and you get your Fibonacci retracements afterwards. If the trend is ongoing, i.e., if it's going to go, there's two types. The full wedge target is the 100% retracement. You only get that really at the end of a trend. And your risk of having ended the trend is much higher if you go over the 61.8% retracement. But normally, you'll just actually be retracing, continuing a trend. And actually, if you look on the bigger picture, i.e. if you take the SPX back to 1923, really what you're looking at there is a series of thrusts and retracements. It's just the normal ebb and flow of the market. I mean, even the 2008-9 crash and 2000, etc. These still H7 crash. These are all just fast Fibonacci retracements. Everyone expects it to go up, and everyone worries when it goes down. But actually, it's just the ebb and flow. It's never collapsing. It's just, if you have a big expansion, you have to have a retracement really before you go on. Sometimes you will extend, but afterwards you will still do the retracement. And that's what we saw in H7 when we had a rising wedge which broke up, did 100% extension, I made the target, reversed close to it, and then did a Fibonacci retracement of those two patterns together. That was just normal. It's what you would expect. And what we're looking at now on the markets, everyone panicking, what's wrong, market's going down, we've had a hell of a move up, it needs a retracement. That's just the way it works.
Yep, that's right. I think you just said a key thing is after an expansion, what do you look for? You look for a retracement. So that's when you use your retracements. When you're in the process of expansion, you look at extensions, okay? When you're looking to finish a move, like for example, something I would look for here in the S&Ps, we've had the expansion, we had the big wave, right? What do we typically find? A lower wave with fewer and fewer declining issues, okay? That's called divergence. So, you know, this is when you use an expansion. We're looking for the fifth wave or the end of the impulse. So I would look for something like this. Let's say we turn tomorrow. The early target would be 1787. Let's say we go all the way to my target up here in the 46 area. My target would be 1780. Okay, because I'm using my expansion tool to show me the 1.236, and I'm looking at that as an early target, not the target. Okay, so I may do multiple fib draws, and another fib draw I would do well, I won't do it, but because I'm getting back into the topic. But I guess the point is, to answer your question, it depends upon where you are in the cycle, as Jack said.
Yep, there's an example I would like you to use.
Yeah.
By the way, that target on CL you gave yesterday, that was a Fibonacci target, right?
Yeah, it was, absolutely.
Could you share that one?
Yeah, sure. Let me ask this question. Damon has a question here on the nano, micro, and major fibs. which are more immediate in their impact as you move away from the major swing? I'll pull up oil while you answer that one.
I'm not sure I understand the question.
On the nano, micro, and major fibs, the different, if you're looking at the at a shorter term,
well,
nano fib.
The reality is, the shorter term your outlook is, the smaller ones are the more important ones.
Mm-hmm.
So, I mean, Fibonacci is something I look at every day.
Yeah.
And when these same patterns that we're looking at on, tracking moves over 20 years or 30 years, etc., we're using them intraday as well.
Yep.
So I use them all the time. So in terms of immediate, day trading, it's the nano ones, and they work very well.
Yep.
It's I think what Stan was saying about multiple time frames is very important. I think I always look at multiple time frames because so I've got an idea of where things are heading. But in terms of the short-term structure, it's the short-term Fibonacci's and patterns which you look at.
Yep. Now this is a classic bear flag here. This is the oil thing that Jack was just mentioning. So first of all, this is an example of overlapping fibs. So we have this big impulse, right? What was I looking for? The 50% retracement. Where does that come in at? 33.46, okay? Did it stop exactly there? No, it was in that area. It was also on this trend line. It was also a 100% fib move. There's a 100% fib move here at 33.44. Here's another 100% fib move. Hold on, I didn't even draw it, but it's here somewhere. I thought I drew it, but I didn't. Here's 100% fib. There's your A. There's your B. 100% fib move, 34.43. And I'll clean this up a little bit so it's more.
Where did the target come from that you quoted on yesterday's video? Because you quoted 34.86.
That was another fib draw, and it's probably on a different chart. I'm sorry, 34.86, is that the pivot? No, I'm sorry, 34.86 right here it is. It's the 618. See, that's a six. The 0.618 is a very, very natural retracement level for oil. Okay, the 0.786 on the S&P, it's a natural retracement level for the S&P. You'll find every future has kind of its favorite level, and it has to do with how many eyes are on it and how the programs are written and whatever. So, here I have 1, 2, 3 different fibs, and I have a box in that area. So, that's
but that spike today was up to 34.82.
Yeah, right. And so, you get that often, and once you get a feel for an instrument, you can get fairly accurate with fibs. When I used to day trade oil, and I used to day trade it every single day, my fibs were within like 5-10 cents. Okay, so you can get that precise if you're trading a 15-minute chart or a 3,200 tick chart. Okay, so on a 1 hour basis, if you're within 30, 40 ticks on oil, you're doing great. Okay, and if you're a swing trader, that's what you're looking for. Do fibs, Jack, apply equally well to all futures?
No. The reality is the patterns. If I take, I did actually do an exercise once when I started charting the entire S&P 500. And what I was finding was, certainly with the more thinly traded stocks, the patterns worked less well, the trend lines were less good, and the Fibonacci's worked less well. It's so if you're looking at something which is thinly traded, then that can be a problem. On everything we're looking at normally the chart is very thickly traded. You've got deep markets, lots of volume. There, the Fibonacci's tend to work extremely well. Some of my favorite instruments, Nikkei, Yen, these are huge, huge. And the Fibonacci's work on them very, very well indeed. So, but certainly on more thinly traded stuff, it's something to be used with caution.
Yep, I agree with you. On thinly traded markets like RBOB or HEAT, and I trade HEAT a lot, you get something called slippage. Okay, where you have a certain fib and there's just slippage in the market in terms of the market's going to stop, but it doesn't stop on a dime. It just keeps going. It's just the nature of those thinly traded markets. So, you get 30, 40 ticks of slippage in those markets. That's normal. And on a volatile day, it's even more than that. So that's just on some markets, it depends upon your risk tolerance. Okay, fibs work, but You know, as Jack said, the heavier traded markets, you know, they're going to be more consistent, I think.
Definitely.
Yeah. Okay. Other questions, guys? I think, Jack, we might have a wrap here. It's apologies everybody for the crash right in the middle of the webinar. Any other questions? Anyone? Thank you, Damon. Jack, I think that's a wrap.
I've got one more.
All right. Let me throw it back to you. Sure.
Okay.
Yep. Go ahead.
Right. Now, this is I'm just throwing it out there because, well, I can really. And I'm just going to blow this up for you. This is something we've been looking at for forever, and this is actually the TNX chart. What you're looking at here, and I just want you to bear in mind the 87 example I showed you, where you had two patterns in a single market. Now, bond market moves last decade. This particular one, you're looking at a move from here in 1981 down to here, where I'm pretty sure it's bottoming out, and it probably made the low in 2012. It's just possible we might retest that this year. But at the moment, this is bottoming out. What will happen once the market turns? Well, the turn will be confirmed when we get over here, which is at 35. 34.5, 35. Beautiful, and we have beautiful falling wedge here, beautiful channel. When it breaks up, what are the main targets? Well, I'm expecting, at the least, it to hit this range here, which is 38.2, the 50, and 61.8. So that would be interest rates of just under 7%, 8.6%, and 10%. And that would be a reasonable expectation. That's going to actually, as and when this move happens, and obviously we'll be watching this a long time, and it's, bonds, you obviously have to wait patiently until something happens. It's as and when it breaks, that's where we're going. That is going to be very interesting, because an awful lot of the policies in the world is predicated on this whole period here being of low and falling interest rates. It's going to be very interesting to see when we move out of it, what happens. Certainly on current projections, that's actually going to send quite a lot of governments over the edge because they're so heavily borrowed. It's going to be a very, very interesting period we go into. But at the moment, we're bottoming out on here. As when it breaks, that's what's coming.
And that signals much lower values on TLT.
Yep, it does.
Yep.
And this is when I talk about TLT going back to 50 and probably going through it. That's what I'm talking about.
Yeah, makes a lot of sense to me. Is there an issue with fibs on futures due to contract roll differences? Well, it depends upon your software. Now, long term, it's much better to use indexes, but if you have software that allows you to concatenate your future contracts together, equalize closes, and so forth, if you can do that, and CQG does that, and some other software does that, you can use fibs longer term on futures. I do it all the time. You have any comments on that, Jack? Jack?
Sorry. I don't actually have software that corrects it. So for the longer term stuff, I tend to use the RTH charts. And also, if you want charts that go back to 1962, you tend to have to use the RTH charts because the futures weren't actually going then. So, but I think we would. I think for all short-term stuff, I mean, I use the 60-minute and daily futures charts all the time. I just tend to switch the RTH charts from looking at periods over a year.
Yep, makes sense.
That does partially depend on the future as well. I mean, when you have a huge difference in the contract roll, that's something to bear in mind. Yep. And that makes that means unless you're correcting it the way that Stan's doing it, then you can't really use the futures charts for longer periods.
Yeah. I think it's dangerous for most people unless you really know and understand. You have to really know and understand future contracts. And if you don't, just stick to our RTH charts. I think that's where I would begin. Start with the S&P. Start with the S&P 500, and then graduate to the Nasdaq. I mean, that's kind of where I would start.
Yep.
Any other questions? I think that's a wrap, Jack.
All right, great.
All right. Thank you very much, everybody. Thanks for the question. Sorry about the crash in the middle of the webinar. That was very odd. See you next Thursday. Take care.
Does that mean we've lost the recording?
No, we have 2 recordings now. I have to put them together, so I'll get that published. Okay. All right.
Cool.
Take care, guys. Bye-bye.
All right. Great. Pleasure as always, mate.
Yep. Same here. Take care. Bye-bye.